So we have in front of us one of the past examination questions, the name of which is Kutchen Company. I repeat, the name of this question is Kutchen Company. What does it say? It says Kutchen Company is a listed company which acquired two subsidiaries, House Company and Match Company. So what did it do? It acquired two companies, which is House Company and another company which is Mark Company. During the year ended 31st December 2006, Niche Company is a third subsidiary that was both acquired and disposed of during the same period. So you've got Niche Company which was acquired and disposed of both during the same period. Kutchen has also restructured one of its business segments during the year ended 31st December 2006. So what has Kutchen done? It has restructured one of its business segment during the year ended 31st December 2006. The following exhibits available on the left hand side of the screen provide information that is relevant to the question. Now, you should know that how the CB practice platform needs to be dealt with and how the CB examination should be dealt with. So although I would be doing these questions, but you should be practicing these questions more and more on your own. Because if you don't practice, then you would not be able to do a good performance. So you should be able to practice well and well. Now the following exhibits available on the left hand side of the screen provide information that is relevant to the question. So one of them is acquisition of House Company, other is Mark Company, the third one of them is acquisition and disposal of Niche Company, fourth one of them is business segment restructure, fifth is Mark Company's subsequent acquisition, and then group SOFP. So the following information should be used to answer the question. So we have got multiple information which is available here. What are the requirements of the question? Let's try to understand the requirements of the question. When we talk about the requirements of the question, it says, explain to the directors of Kutchen Company with suitable workings. With suitable workings, how goodwill should have been calculated on the acquisition of House Company and the initial acquisition of March Company, showing the adjustment that needs to be made to the consolidated financial statement at 31st December 6 to correct any errors made by the finance director. So finance director has probably done the working. What you need to do is that you need to perform the calculations for them. Now, the second requirement is explain with suitable workings how the gain or loss on the sale of Niche Company should have been recorded in the group financial statement. So there is a disposal transaction that also needs to be considered. Then discuss with suitable workings how pension scheme should be dealt with after restructuring. Okay. Advise Kutchen on the difference between equity and liabilities on the proposed accounting treatment of the contingent payments and the subsequent acquisition anyways. So that's what we have. Let's talk about this acquisition of House. So if I talk about acquisition of House, let's try to have a bit of a discussion on this. If I talk about the acquisition of House, let's try to have a bit of an understanding of it. It says on 1st June 2016, Kutchen acquired 70% of the equity interest of House. The purchase consideration comprised $20 million $1 shares of Kutchen Company at the acquisition date, and a further 5 million shares on 31st December 7 if House Company's net profit after taxation was at least 4 million. Now see, let's try to understand this thing. I'm just using the word processing document to write down my notings. Rather than using a scratch pad, I am more comfortable using the word processing document. So what are the important things? It is actually telling us that 70% is acquired and the purchase consideration comprised of this. So you could just copy it and you could even paste it. So 70% equity interest of House. Secondly, the purchase consideration was what? 20 million shares. The purchase consideration was 20 million shares of $1 each of Kutchen Company at the acquisition date, and a further 5 million shares on 31st December if profits exceed. So it's actually more of a contingent consideration that you have agreed to. More of a contingent consideration that you have agreed to. Now what next is there? Next it says the market price of Kutchen shares on 1st June was $2 per share and that house companies was 4.2 per share. It is felt that there is a 20% chance of the profit target being met. Okay. In the accounting for the acquisition of house, the finance director did not take into account the non-controlling interest in the goodwill calculation. He determined that a bargain purchase option of 8 million arose on the acquisition of house company, being the purchase consideration of 40 million less the fair value of identifiable net assets of 48 million. This valuation was included in the group financial statements in exhibit number 6. If I could just go on to see exhibit number 6. So with respect to exhibit number 6, we don't have any goodwill. We have only got this bargain purchase option, gain on bargain purchase. After the directors discovered the error, they decided to measure NCI at fair value at the date of acquisition. Fair value of NCI in house was to be based upon quoted market prices at acquisition. The share capital of $1 each totaling 13 million at the date of 1st June, and there has been no change in this amount since acquisition. Now let's have a bit of a discussion about it. So if I try to calculate, because my first requirement to this is that I have to explain to the directors of Kutchen Company with suitable workings how goodwill should have been calculated on the acquisition. Now, so the first one, if I try to calculate the goodwill in house company, I repeat, if I try to calculate the goodwill in house company, how exactly is it going to be done? So what happens is that the first one of them is the purchase consideration. The shares issued right now and the shares to be issued. So one of them is the shares issued and the other one of them is the shares that are to be issued. One of them is the shares issued and the other one of them is shares to be issued. Now what next is there? The next situation is, then you have got the non-controlling interest. And furthermore, what do they have? They've got this non-controlling interest plus, in addition to the non-controlling interest, there is going to be the fair value of identifiable net assets. Now let's just try to have a bit of a discussion. Let's try to have a calculation. First of all, it says 20 million shares. The purchase consideration was 20 million shares of $1 of Kutchen at the acquisition date. The market value of the Kutchen share was $2. $20 million shares, each share is of $2. So this is actually going to be this into this. Then what happens is shares to be issued is 5. I repeat, the shares to be issued is 5. The shares to be issued are 5. What next is there? So you would remember that this is a contingent consideration and should be included in the cost of investment, even if it is unlikely that it would be recovered, even if it is unlikely that it would be received. So what you should be doing here is that you should include it in the cost of investment. So resultingly what happens is that you have this here. The non-controlling interest is going to be calculated like this. The market value of house's share was 4.2. What are the total number of shares? 13 million shares. So you've got 30%. You've got 30%. And then what happens is that 13 million shares Now what actually happens is that this is 30% multiplied by 13 million. The value of each share is 4.2. So resultingly the value of NCI is going to be 16.38. The value of NCI is going to be 16.38. Now what next is there? The fair value of the identifiable net assets. The fair value of the identifiable net assets is 48 million. Now, so resultingly the goodwill that needs to be calculated. I have already incorporated this 5 million shares, because what happens is that what you actually need to do is that the contingent consideration has to be ignored. So the goodwill has to be what? The goodwill has to be the sum of all this, which is 18.38. I repeat, the goodwill has to be the sum of all this, which is 18.38. So the goodwill which has been discussed or calculated right now has to be edited, has to be adjusted. Now what next is there? So we have already done this calculation. Now the next is Mac company. Let's talk about this company, that what exactly is the relevant item pertaining to this specific company. So it says on 1st of January, we have not ignored contingent consideration. I've covered the contingent consideration. I've covered the contingent consideration, which is the shares to be issued. Further 5 million if net profit after tax. I have not ignored it. I have ignored the likelihood of the conditions being met or not. I have considered it. I am sorry, this question cannot be shared. It is available on the ACCA CB practice platform. You all can access it in the ACCA CB practice platform. I cannot share it. Okay, now as per the requirement of the IFRS, even if it is unlikely that the consideration would be for the contingent consideration, even if it is unlikely that it would be paid, still you would recognize it. Now this is going to be the goodwill in Mac company. If I try to calculate the goodwill in Mac company, I am just copying this whole calculation here, because it is actually going to help me in doing the workings. It says on 1st January 2006, Kutchen acquired 80% of the equity interest of Mac company, a privately owned entity, for a consideration of 57 million. Consideration comprised cash of 52 million and the transfer of non-depreciable land with a fair value of 5 million. Okay, so what happens is that the goodwill in Mac company with respect to the purchase consideration, the cash paid is going to be 52 million. The fair value of land transferred is 5 million. The fair value of the land transferred is 5 million. The carrying amount of the land at the acquisition date was $3 million. And the land has only recently been transferred to the seller of the shares in March company. This transfer has not yet been accounted for and is still carried at 3 million in the group finances statement. So you should have de-recognized this land. This is not required to be recognized, you should have de-recognized it. Anyways, we'll look at it. At the date of acquisition, identifiable net assets at a fair value of 55 million. March company had made a profit attributable to ordinary shareholders of this. Directors wish to omit the NCI at fair value at the date of acquisition, but had again omitted NCI from the goodwill calculation. NCI is to be fair valued using a public entity market multiple method. This is simply a P ratio based value measure. The directors of Kutchen have identified two companies who are comparable to March company and are trading at an average price earning ratio of 21. These companies are trading at a price earning ratio of 21. Director adjusted the P ratio to 19 times. Okay. So director says that our P ratio is going to be 19 times. For differences between these entities, for the purpose of fair valuing the NCI, the finance director has determined that a bargain purchase of 3 million arose on the acquisition of March company, being the cash consideration of 52 million less the fair value of net assets of March company of 55 million. Gain on bargain purchase has been included in the group financials above. Now see, let's try to understand this. If I try to tell you people the formula for the computation of value using P ratio. So the formula of P ratio is share price divided by EPS. Alternatively, you could also calculate P ratio like this: profit after tax divided by the market capitalization divided by profit after tax. So if I try to rearrange this, it would become P ratio multiplied by profit after tax is equivalent to market capitalization. The P ratio multiplied by PAT is equivalent to market capitalization. P ratio is 19 times. The profit after tax I just need to see if there are other information available or not. We have got group SOFP. Okay, we have got a profit attributable to ordinary shareholders for the previous years to be 3.6 million. What? 3.6 million. Now let's just try to understand. What happens is that this is all going to be cash paid is this. Now 19 times the P ratio. In fact, let's try to calculate the number of shares. You've got 20% multiplied with what is the number of shares? Let's just try to see. Okay, we are not being given the number of shares, we just need to do the calculation. So what actually happens is that, let's just try to see this. The whole value of the business is going to be 3.6 multiplied by 19. The whole value of the business is going to be 3.6 multiplied by 19. And then there is this 20% that belongs to NCI. So the NCI is going to be what? NCI is gonna be this 68.4 into 20%. The fair value of the identifiable net assets was what? 55 million. Hence, resultingly, the goodwill would become 15.68. I repeat, resultingly, the goodwill would become 15.68. Resultingly, the goodwill would become 15.68. Now, let's just move a bit forward. Let's discuss further. This is NCI at fair value, and you are not being provided any method of valuing the NCI except for P ratio based valuation. So as I told you that you need to do this formula, you need to use this formula for the P ratio into PAT is market capitalization. So I use the P ratio of 19 times multiplied by PAT, which was 3.6. So I got the market capitalization, which was 68.4. And this 68.4 is to be multiplied with what? 20% to get the NCI. So now what have we done? We have calculated this to be 15.68, 18.38. What is the requirement to the question? Explain to directors of Kutchen Company with suitable workings. What is it? With suitable workings, how goodwill should have been calculated on the acquisition of house company and the initial acquisition of merged company, showing the adjustment that need to be made to correct any errors made, so and so, so and so. So now what is it that you need to do? You need to tell the examiner these things, that goodwill for both house company and merged company have been calculated in the spreadsheet. The goodwill calculation for Kutchen should include the fair value of the deferred of the contingent shares as a consideration. The goodwill calculation for Kutchen Company should include the fair value of the contingently issuable shares as a consideration, even if it is very less likely that this consideration will be paid. So although it is less likely that this consideration will be paid, but still you got to record it. You got to record it. Now what next is there? The NCI should be included. In the goodwill calculations at fair value, and resultingly the NCI should be included in the goodwill calculation at fair value, and resultingly the gain on bargain purchase recognized in the P&L is to be reversed. The gain recognized in the P&L is to be reversed. There are 5 million further shares that are to be issued, and each share has a value of 2. So 5 into 2 makes it 10. You got to include 10. You got to include 10. Yes, we need to take the share price at the acquisition date, because we are not being, I mean, like we have granted these, or we have committed this contingent consideration today. So we need to calculate the price as of today. We need to calculate, or we need to use the price as of today. Now the next situation is, it says the market price of Kutchen companies, in fact, sorry. Okay, now with respect to March company, the land transferred should be derecognized, since entity intends to measure the NCI at fair value, therefore P ratio based fair value method for valuing NCI should be used, and such fair value incorporated in the goodwill calculation, and such fair value incorporated in the goodwill calculation. So you got to explain this to the examiner that, look, this is what you have to do. Now what's the second requirement? It says, and also one thing, you could even copy the questions requirement here in the word processing document, and you could even write down the requirement like this and make it bold, so that it becomes much clearer for your answer to be. Okay, now there is one thing which is a question that you people have, which is that if there is a 20% likelihood that this amount would be paid, so should we not be recognizing a 20% consideration? The answer is no. You should be recognizing 100% consideration. There is only a 20% probability that it will be paid, but there is nowhere it's mentioned that only 20% would be paid. No, the 100% would be paid. It says explain with suitable workings how the gain or loss on the sale of niche company. Okay, just wait a bit, I have missed out rectification of one or two of the errors. Just let me do it. The land transferred should be derecognized, and a gain of 2 million, which is the difference between 5 million and 3 million, is to be recognized. The land transferred should be derecognized, and a gain of 2 million is to be recognized. The gain of 2 million is to be recognized. Next is explain with suitable workings how the gain or loss on the sale of niche should have been recorded in the group financial statements. So let's talk about this niche company. It says Kutchen had purchased an 80% interest in niche for 40 million on 1st January 2006. Kutchen had purchased an 80% interest in niche company for 40 million on 1st January 2006 when the fair value of identifiable net assets was this. The partial goodwill method. The partial goodwill method is basically where the NCI is measured at proportionate share. Had been used to calculate the goodwill and had an impairment of $2 million. Had arisen in the year ended 31st December 6. Holding in niche was sold for 50 million on 31st December 6. So you have actually disposed of 100% holding, losing the control. The carrying amount of niche identifiable net assets other than goodwill was 60 million at the date of sale. Kutchen had carried the investment in niche at cost. Okay, that's for the individual financial. The finance director calculated that a gain of 2 million arose on the sale of niche in the group financial statement, being the sale proceeds of this minus this. Being the share of the identifier, this was credited to retained earnings. Okay, so they have probably made an error which they need to be rectified, which needs to be rectified. Now how is it all going to be rectified? Let's just try to see this. Okay, niche company. I'm just going to do some word processing for this specific part. I am repeating, I'm just going to do some word processing for this specific part. Now let's try to understand this. Entity acquired 80% shares of niche and niche became a subsidiary. At the year end, the entire shareholding in niche was disposed of. Niche is to be recognized. Niche is to be de-recognized from the financial statements. Niche is to be de-recognized from the financial statements. Niche is to be de-recognized from the financial statements, including the goodwill, NCI and net assets. Gain or loss calculated as per the spreadsheet workings shall be recognized in the P&L. A gain or loss shall be recognized in the P&L. Now let's just try to see this. How exactly are the calculations going to be done? For the niche company, the cost of investment is 40 million. I repeat, for the niche company, the cost of investment is 40 million. The non-controlling interest has to be used in a proportionate method. Fair value of net assets is going to be 50 million. The NCI is going to be sorry, just wait a bit. I have probably made an error. The fair value of the identifiable net assets was 44 million. NCI is going to be 44 into 20% because it's a proportionate method. So hence, on the basis of this, the goodwill is going to be the sum of all this gives you 4.8 million to be the goodwill. Gives you 4.8 million to be the goodwill. Now let's just try to understand. For the impairment workings, what information was available? For the impairment working, it says that an impairment of 2 million had arisen in the year ended this. Finance director, the carrying amount of net assets other than goodwill was this. Kutchen had carried the investment in niche at cost. Okay, now let's just try to understand. Basically what happens is that if there was an impairment loss of 2 million, multiplied by 80% of this is to be recognized. So 2 into 80% gives you 1.6 million that needs to be recognized. Now how exactly are we going to do the workings further? Let's just see. Upon disposal, the gain or loss for the group accounts shall be as under. The gain or loss for the group account shall be as under. Now what is going to be the gain or loss for the group accounts? You would say disposal proceeds, which is 50 million, less the goodwill that is to be derecognized. It was 4.8 million, but overall if 2 million impairment loss has arisen, so with respect to the partial goodwill only 80% would have been recognized because the parent owns 80%. So the goodwill that needs to be removed is 3.2. The carrying amount of net assets is 60. The non-controlling interest will be this into 20%. Hence, resultingly what happens is there is actually a loss on disposal of 1.2, and the above loss is to be recognized in P&L. So this is what the working for niche company is going to be. I repeat, this is what the working for niche company is going to be. So this is how you will work for a niche company. So what have we done? We have gone through these two requirements. One of them was, we have gone through these two requirements, A and B. Now let's move a bit forward, let's talk further. The third one of them is discuss with suitable workings how the pension scheme should be dealt with after the restructuring by Kutchen Company of its business segments, and whether a provision for restructuring should have been made in the financial statement. Now see, what is it trying to do? What does it want to do? Let's just try to see this. It says Kutchen Company has decided to restructure one of its business segments. The plan was agreed by the Board of Directors on 1st October 2006. Kutchen Company has decided to restructure one of its business segments. The plan was agreed by the Board of Directors on 1st October 2006 and affects employees in two locations. In the first location, half of the factory units have been closed by 31st December 2006. So there are actually two locations, and in one of the location, half of the factory units have been closed, and the affected employees' pension benefits have been frozen. Any new employee will not be eligible to join the defined benefit plan. After restructuring, present value of defined benefit obligation is 8 million. The following table relates to location 1. Value before restructuring, the defined benefit obligation are 10, the plan assets are 7, the net pension liability is 3. Okay. In the second location, all activities have been discontinued. It has been agreed that employees will receive a payment of 4 million in exchange for the pension liability of 2.4 million in the unfunded pension scheme. Kutchen estimates cost of our restructuring excluding pension costs will be $6 million. Kutchen has not accounted for the effects of restructuring in its financial statement because it's planning a right issue and does not wish to depress the share price. Therefore, there has been no formal announcement of the restructuring. So they have not formally announced the restructuring. I repeat, they have not formally announced the restructuring. Now, so if I could just go on to discuss about the requirement of the question, which says, discuss with suitable workings how the pension schemes should be dealt with after the restructuring by Kutchen Company of its business segments, and whether a provision for restructuring should have been made in the financial statement for year ended so and so. Okay. discuss with suitable workings how the pension scheme should be dealt with after the restructuring by Kutchen Company of its business segment, and whether a provision for restructuring should have been made in the financial statement or not. Now see, with respect to the pension scheme, a gain/loss on curtailment is required to be recognized as under both the scheme, Kutchen Company has entered into a transaction of curtailing the benefits payable. So what has Kutchen Company done? It has actually entered into a transaction of curtailing the benefits payable. Now what does it say? So with respect to location 1, the revised present value of defined benefit obligation is is 8 million as compared to 10 million before restructuring. There is a 2 million reduction. There is a 2 million reduction in the liability and should lead to again being recognized in the P&L. For the second location, assets of 4 million have been used to settle the obligation of 2.4 million, resulting in a loss on the curtailment/settlement, and it should be recognized in the P&L. For the restructuring provision that is to be recognized, a constructive obligation to restructure under IAS 37 is required to exist. A constructive obligation to restructure under IAS 37 is required to exist. The requirements for constructive obligation to exist include the following: detailed formal plan identifying locations affected, number of employees affected, date when plan will be implemented, So the locations affected, the number of employees affected, the date when the plan will be implemented, and the expenses to be incurred. Plus, there is another requirement which is a valid expectation is created amongst those affected by entity either starting to implement the plan or announcing the main features of it. So under the current situation, the main features seem although a public announcement has not been made as yet, but the employees have the hint that the plan has started to be implemented, and hence the constructive obligation to restructure exists. So hence the constructive obligation to restructure exists. Now what is the next requirement? So we are done with part C also. There is a last final requirement on this question. Advise Kutchen on the difference between equity and liabilities and on the proposed accounting treatment of the contingent payments on the subsequent acquisition of 20% of Mark Company. Let's talk about it. It says when Kutchen Company acquired the majority shareholding in Mark Company, there was an option on the remaining 20% NCI. There was an option on 20% remaining NCI which could be exercised at any time up to the 31st March 2007. On 31st January, Kutchen acquired the remaining NCI in Mark Company. The payment for the NCI was structured so that it contained fixed initial payment and a series of contingent amounts payable over the following 2 years. Contingent payments payable over the following 2 years. The contingent payments were to be based on the future profits of Mark up to a maximum amount. Kutchen felt that fixed initial payment was an equity transaction. Additionally, Kutchen was unsure as to whether to account for the contingent payments were either equity, financial liability or contingent liability. After a board discussion which contained disagreement to the accounting treatment, Kutchen Company is preparing to disclose the contingent payments in accordance with IAS 37, so and so, so and so. The disclosure will include the estimated timing of the payments and the director's amount to be settled. Now, what exactly is the requirement to the question? It says advise. What does it say? It says advise Kutchen Company on the difference between the equity and the liabilities and on the proposed accounting treatment of the contingent payments on the subsequent acquisition of 20% of Mark Company. So, what is an equity? Equity is an instrument that evidences residual interest in an entity. Common examples of the equity instruments include shares and share options. Common examples include the shares and the share options. With respect to liability, what is a liability? Liability is a contractual. Liability is a present obligation as a result of past event whose settlement will require a probable outflow of economic benefits. Now, the major difference between equity and liability are that there is an absence of obligation to pay cash in the equity instruments. There is an obligation to pay cash in the equity instruments. Now, with respect to the acquisition of additional 20% shareholding, such transaction is considered to be an equity transaction under IFRS 10, and a gain/loss on the acquisition is to be recognized within the equity. Since IFRS 3 business combination does not apply to such transaction, therefore, since IFRS 3 business combination does not apply to such transaction, therefore, the contingent consideration shall be accounted for under IAS 37 and shall only be recognized as a liability if it is probable that it will be paid, or else a contingent liability is to be disclosed where the details of the event and the estimated financial impact is to be considered. So that is how you are going to account for this specific question. Okay, for the SBR, if there is a student who is asking that how to draft the answer, so I would say one thing only, which is that you just keep on writing the relevant points. That's it. You need to have all the relevant points in mind, and then that is sufficient enough. Maybe if you would like to write like 5 points, 7 points, no, that's not right approach. For this, you need to make sure that what are the relevant points that I need to write. So we are done with this question, the name of which was Kutchen Company, and we have applied the CB practice platform to it.